The stock market just had its worst day since February. But does that mean that this market rally is over? Or is this just a one-day sell-off where the market's going to start going back up again? As you probably know by now, Fitch downgraded the US long-term credit rating to AA plus from AAA. This was the same downgrade that the S&P gave the US credit rating all the way back in 2011. The Nasdaq dropped more than 2% in its worst day since February as the Fitch downgrade ignited a sell-off. And it wasn't just US stocks that went down. The US debt downgrade sank global markets as well. But interestingly, economists are not concerned. The thing you have to understand about this downgrade is it's kind of like your own personal credit score going from an 850 down to an 840. Yeah, it's a down, but it's not horrible. Goldman Sachs said the downgrade is not expected to have a lasting effect on market sentiment beyond an immediate shock selling on Wednesday. Goldman Sachs said the downgrade should have little direct impact on financial markets, as it is unlikely that there are major holders of Treasury securities who would be forced to sell based upon the ratings change. Fitch's fellow ratings agency, the S&P, downgraded the U.S. sovereign rating in 2011, and although it had a meaningfully negative impact on market sentiment, the S&P 500 index recovered 15% over the following 12 months. This view was echoed by Wells Fargo, who said the Fitch downgrade should not have a similar impact to the S&P's 2011 downgrade, where the S&P fell 6.7% in one day, given the starkly different macro environments and other reasons. Wells Fargo believes any pullback in stocks would be relatively short and shallow. This sentiment was backed up by JP Morgan CEO, who said the Fitch rating downgrade was ridiculous and said it really doesn't matter. You see, in 2011, when the S&P downgraded the U.S. credit rating on August 5th, 2011, the stock market sold off rapidly. The S&P 500 fell 7%, the Nasdaq fell 16%, all over the course of about 2 weeks. But the stock market also recovered just as fast. In fact, the S&P 500 was up 15% in the 12 months after the downgrade, and the Nasdaq was up over 20% in the 12 months after the downgrade. In fact, just 1 month after the downgrade, the entire sell-off had been recovered. So even though this definitely does cause a significant short-term impact, and stocks might continue to fall for the next, say, rest of this week or maybe through the end of next week, the downfall should be relatively short-lived, and the stock market should recover just as quickly. At least that's what happened in 2011. Well, can it happen again? The Wall Street Journal isn't so sure. The Wall Street Journal said investors are drawing false comfort from the past. The Wall Street Journal pointed to the fact that the reaction in the bond market Wednesday morning to Fitch's move was the opposite of what it was back in 2011. In 2011, the bond market was fairly unscathed, but this time around, the bond market sold off, with Treasury yields skyrocketing. The reason for this is because the US borrows in its own currency and will never actually default involuntarily as long as it has a printing press. As rising rates push that financing need higher, though, the ability of the US government to change the fiscal path without politically disastrous measures like cutting entitlements or by overtly printing money and skyrocketing inflation is becoming more limited. If no such radical steps are taken, then it almost certainly means paying more to borrow. And that rising risk-free rate will crowd out private investment and dent the value of stocks, all else being equal. In other words, this time is different from 2011, and the market should be far more concerned, partially due to the fact that interest rates are significantly higher than they were in 2011, And inflation also remains well above the Fed's 2% target, meaning interest rates are likely to go higher. Therefore, the impact of a credit rating downgrade for the US economy is a far more significant impact than it was in 2011 when the interest rates were near zero. This sort of problem was described by policy analyst Michelle Wooker in her 2016 book, The Gray Rhino. Unlike an out-of-the-blue crisis dubbed a black swan, a gray rhino is a very probable event with plenty of warnings and evidence that is ignored until it's too late. And that's what has a lot of bears worried, is that there are a lot of warning signs that the US economy is in major trouble. Both rising interest rates that have not really been priced into the equity market yet. We've got the fact that all leading indicators are pointing to the US going into a recession if it's not already in one. We have the fact that the labor market is slowing down. The fact of the matter is the actual annual wages that people are earning is going down because people are going out and getting second and third jobs just to be able to pay their bills. We see consumer spending going down. We see earnings from companies going down. We have the housing market dropping. All red flags that the US economy is either in a recession or about to enter a recession. Yet, the stock market is completely ignoring all of the warning signs. And this could be one of these gray rhino events where all of the warning signs are there, they just get ignored until it's too late, and we end up with a major sell-off in equities. At least that's the viewpoint of the Wall Street Journal. Now, whether you believe economists and bank CEOs or you believe the Wall Street Journal is up to you, but I just wanted to give you both viewpoints so that you can be prepared for whatever might happen next. Now, even though the leading indicators all point to a recession, the official data, which is the jobs data, ADP reports, things like that, all point to the labor market remaining quite strong. In fact, the private sector added 324,000 jobs in July, which was well above expectations. And this points to a very good chance of the Friday official jobs number coming in much higher than expected as well, which historically has pushed stock prices higher. On the flip side, though, mortgage demand from homebuyers has dropped for the third straight week as interest rates continue to rise. And as demand from home buyers goes down because they can no longer afford homes, this is causing home prices to fall. Now, this is actually could be a major problem for banks and really the US economy. We've already seen a significant drawdown in the commercial real estate sector, and a lot of people think that the losses in the commercial real estate sector are going to cause a lot of bank failures later this year. And we already saw PacWest end up getting bought out to avoid a collapse due to their losses on their commercial loans. Now, the question comes down to the residential real estate. This is exactly what caused the 2008 financial crisis. And I don't know how it is in your part of the country. I know for my city where I live, home prices are down about 10% from just 6 months ago. Now, the reason this is significantly important is because a lot of people have very close to a 20% equity in their homes. And this comes from a conventional mortgage or HELOCs or however they end up doing it. Some people have less than 20% equity as they may have financed with as little as 3.5% down with an FHA or 5% down or maybe 10 or 15% down. But whatever it is, even though there is private mortgage insurance to cover some losses, at least from the lender side, it can still hurt banks. Now, in 2008, that key critical level that caused a huge wave of defaults in the United States was a 15% decline in the price of houses. And some parts of the country have already seen a 15% decline. Where I live, I've already seen a 10% decline. And the point is, we are getting very close to that critical 15% decline that could start to trigger a huge wave of defaults as people start to get behind on their mortgages due to layoffs, and they realize that it's not even worth trying to sell their house because they're going to end up selling their house for less than what they owe. So what's the point? They just stop paying their mortgage, and then sometime a year or 2 years down the road, we end up with a ton of foreclosures and the banks really get hit hard. So what may end up happening very soon here is we see the banks deal with a commercial lending crisis in 2023 and 2024, and then they have to turn around and deal with a residential crisis in the end of 2024 and into 2025. And this is why in 2008, we saw over 1,000 banks collapse, but only about 300 of those banks collapsed in 2008. The other 600, 700 banks collapsed in 2009 and 2010. So we might be dealing with a banking crisis for the next 2 years if this continues. The only way this is going to get fixed is if the Federal Reserve starts lowering interest rates. And right now, they are showing no signs of lowering interest rates. In fact, they said they're going to continue to raise them. Now let's move on to the stock news and earnings that are moving the market today. Humana shares rose after the insurer said medical costs came in lower than expected. Remember that a company can increase profits in one of two ways. They can either increase profits by increasing revenues, or they can increase profits by lowering expenses. And lately, during this past earnings season, we have not seen a lot of companies increase revenues, but we have seen a lot of companies lower expenses, mainly due to layoffs, but also through a few other means. And as a result, this is causing some stocks to rise, even though the revenue isn't that great and consumer spending continues to go down. And shares of Chinese Tesla rival XPeng fell 5% after the head of autonomous driving resigned. This doesn't really have a huge effect on the overall market, but it is interesting to see how Tesla's dominance in full self-driving or autonomous driving continues to be the head of the entire market. And hopefully there is some opportunity for Tesla at some point in the future to start selling or leasing or licensing their autonomous driving capabilities to other companies. And Yum Brands missed on revenue estimates despite soaring KFC sales. Despite missing revenue expectations, Yum Brands was only down about 1% on the day, which is pretty impressive considering the overall market sell-off. Ferrari, meanwhile, raised their guidance after their profit jumped as more customers personalized their sports cars. This just goes to show that the poor continue to get poorer while the rich continue to get richer. Qualcomm, unfortunately, their sales and forecasts came up light as smartphone chip sales fell 25%. Revenue came up short at $8.44 billion versus $8.5 billion expected, and earnings came in at $1.87 per share versus $1.81 expected, but you have to understand this was $1.87 per share adjusted. We've talked about adjusted earnings before. This is where a company will essentially just kind of magically eliminate some of their expenses from their earnings and say, oh, look, without these expenses we had, we beat your expectations for earnings. We had a great quarter because we just ignored some of our expenses that we had. It is ridiculous. It's stupid. It is lying to you and shareholders. Yet companies continue to do this. Investors were not impressed, however, and the stock sold off over 7% after hours. Qualcomm's declining sales are just another indication of the global slowdown in consumer spending that has caused all of the leading indicators to point to us either being in a recession or about to enter a recession. And PayPal stock fell as their earnings beat, but a margin metric missed. This is almost identical to what happened to Tesla, where they had an earnings beat, but because of bad margins, the stock sold off. PayPal shares were down almost 7% after hours, after already losing 3% on the day. And Shopify made some progress on free cash flow, but their stock still moved lower after earnings. Shopify reported a comprehensive loss of $1.3 billion, or $1.02 per share, which was even worse than the 95 cents per share loss from a year ago. Shopify shares were fairly flat after reporting earnings, but they had already dropped over 7% on the day. So those are the major earnings that came out on Wednesday. Let's take a look at what's happening on Thursday. Thursday, we have a ton of companies reporting earnings. Coinbase, Block, Airbnb, DraftKings, Cloudflare, all very popular with retail investors. But the two big ones that are going to be major market movers are Amazon and Apple. Now, unlike a lot of other stocks that have reported earnings that have gone into the earnings season with insane valuations, Apple is coming into earnings with a forward PE ratio of only 32. Now, what's interesting about this Apple forward PE ratio is that it's almost identical to the current PE ratio, meaning that analysts are expecting nearly zero growth from Apple over the next 12 months. Now, that seems to me to be a bit of a low expectation, but given the fact that Qualcomm just reported some pretty bad earnings from a decrease in smartphone sales, it's very possible that Apple might see the same kind of decrease. And Apple isn't exactly extremely strong in the AI game, so there's not a lot of hope for AI buildup there. Therefore, it looks like the earnings are really going to focus on the sales. And whether or not Apple can do well is, again, going to depend upon kind of how their sales were for the past quarter. What's interesting is Apple doesn't officially give forward guidance, but they do give forward guidance because they give a whole lot of details on the earnings call, even though it's not really official forward guidance. So I don't think the earnings this quarter are really going to matter. We've seen 2 quarters in a row where Apple had some pretty bad earnings and the stock initially fell. But then once the earnings call started, man, I got to tell you, that team over there, they are amazing at pumping up investors, getting them excited. And for the last 2 quarters in a row, the earnings have been horrible. But then as soon as that earnings call started, investors just bought up the stock because of everything they were hearing. So it's going to be very interesting to see if they can continue to build that investor hype despite another bad quarter of sales. I have no idea which way this is going to go, but I would say that because the stock is a lot closer to a fair valuation, still a little high, don't get me wrong. The average PE ratio in the S&P right now is 19.8, and Apple's sitting at 32, so it's definitely high. But so far, the earnings call has been able to pump up investors, so I think there's a really good chance that Tim Cook and the team can continue to do that again this earnings season. I don't see a strong reason for Apple to fall after earnings unless, for whatever reason, we've seen a major shift in market sentiment. But at least as of Wednesday's close, the market sentiment was still bullish. So I would tend to believe that Apple would rise after earnings. But given everything that happened on Wednesday, I think it's a little bit hard to say. Amazon, on the other hand, is going into earnings with a past PE ratio of 310 and a forward PE ratio of 80. So not only is Amazon going into earnings already pricing in a 300% increase in earnings over the last year from analysts, but then stock market investors have quadrupled that. The stock is literally going into this earnings season pricing in a 1,200% increase in earnings over the past year. Amazon literally has to 12x their earnings from last year in order to get to the current valuation on the stock. Amazon is more overvalued than Tesla was going into earnings. And for that reason, I think there's a very strong chance that Amazon is going to fall after earnings. Even if they beat earnings expectations, the valuation on Amazon is so high, it is impossible for Amazon to meet the valuation that it's currently at. And I think it's going to do exactly what Tesla did. I think it's going to beat expectations, at least for earnings season, but I think the stock is going to sell off because the value is just so stupidly high right now. And yes, I bought a straight put option on Amazon. That is how much I believe that this stock is going to fall after earnings. Now, if you want to know how to trade options during this earnings season, especially if you want to go beyond basic knowledge of calls and puts, and you want to learn how to make money in some other ways that are far more lucrative than just buying calls and puts, I encourage you to come join our coaching program where I will teach you how to trade the more complicated options, such as multi-leg options, credit spreads, iron condors, straddle strangles, butterflies, and all of the different ways that you can make money with options without basically gambling on earnings. If you're interested in learning more about the coaching program, just schedule a call with my onboarding specialist who can give you more information on the program. You can ask him whatever questions you want and just see if this would be a good fit for you or not. You can schedule a call with the onboarding specialist at weprofitdayandnight.com. That's weprofitdayandnight.com. I also wanted to let you know I will be doing some free training on Saturday, going over some basic spreads, specifically looking at credit put spreads and credit call spreads, so that you can get a little idea of what you might actually learn in the coaching program. And if you want to get some of that free trading, just keep your eye out on YouTube. The free trading will occur on Saturday on YouTube. I don't have the exact time yet, but I'll probably let you know tomorrow exactly what time that training will occur. So keep your eyes posted on Saturday on YouTube for that free training. And if you got a lot out of this video, please be a good friend. Share this video on your social media pages so that others will know what's going on in the stock market. Don't forget to hit the like button and subscribe. And if you missed the video I posted yesterday where I covered some of the other earnings that came out, some of the other reasons why the stock market might go up or down during this earnings season, make sure you watch the last video that I uploaded here.